Hey! Hi guys, and welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, a veteran stock markets and derivatives trader, analyst at Cointelegraph. Today's show we will start by discussing soft landing, the odds of the Federal Reserve successfully reducing inflation without causing a recession. The New York Times headline perfectly describes the situation. Could the recession in the distance be just a mirage? Rising interest rates were widely expected to put the US economy in reverse. Now, things are looking rosier, but don't pop the champagne corks yet. The year is more than half over, the recession is nowhere to be found. Not certainly in the job market, as the unemployment rate at 3.6% is hovering near a 5-decade low. Not in consumer spending, which continues to grow, nor in corporate profits, which remain robust. Not even in the housing market. We all know someone that predicted that markets would crash, that commodities, including oil and gold, would soar to all-time highs, or that inflation would run through the roof. The fact is, none of that happened. There will always be evidence of weaker economies here and there. That includes billion-dollar commercial property funds going bankrupt. But how do we know that that is not exclusively related to socialist government actions, as in California, or a more broader work-from-home trend? Because when we look at the big picture, the real estate prices have been stabilizing over the past few months. One could always argue that the effects of the monetary tightening movement remain ahead, or that the Federal Reserve will be forced to cut interest rates and inflate their balance sheet to prevent a recession. That's a lot of ifs, and even if that happens, who knows whether the business and families will scale back on consumption and investments. Some examples that mitigate this eventual turnaround of the central bank's recessionist policies include higher profit margin from tech companies, either to competitors going bankrupt or simply because hiring and expanding their business becomes cheaper as there's less competition. The truth is, inflation came down a lot faster than anticipated, and companies are likely going to do well in the third quarter. The two main risks to the system, namely the banking crisis and the energy costs, have, at least for the moment, been mitigated. That doesn't mean that every one of the top 100 companies in the world will present earnings growth, but probably enough to justify an all-time high for the S&P 500. Now, back to the New York Times article. With the economy already slowing, even relatively small developments, such as the looming resumption of student loan payments, which will strain the finances of many younger adults in particular, could be enough to knock the recovery off course, said Jay Bryson, chief economist for Wells Fargo. Wait, why on earth more money available for former students who trigger a crisis? Simple. Populist measures result in less money available in the government's coffers. In time, that will require further debt issuing, which will cause investors to be less inclined to hold US government treasuries. In short, when investors lose confidence in the US dollar, things can quickly spiral out of control. That explains why BlackRock's CEO, Larry Fink, is bullish on Bitcoin despite the economy doing fairly well. It's a hedge that doesn't cost much and might work regardless of the crisis happening in 2024 or 2028, because it maintains its monetary policy and censorship resistance. Now, let's move to bonds, or debt instruments, the world's biggest market. JPMorgan Assets Bob says global bond rally is just starting. The JPMorgan Asset Management Chief Investment Officer for Fixed Income has been gearing up for a bond rally since late last year, buying high-quality government bonds, credit, and emerging market debt as they fell to multi-year lows. Wait, what? This guy has been buying corporate and government bonds while the inflation was soaring? Have you ever heard of buy low and sell high? That's exactly what JPMorgan's CIO has been doing. Because if you buy debt instruments when the inflation expectation is high, you get a higher yield. It doesn't matter what actually happens later on. You lock on your earnings the moment you acquire the bond. Well, how does that work? Let's say a bond instrument has no interest rates payment. It was launched 1 year ago at 92 and it will mature at 100 in 1 year. Basically, whoever bought it at the launch would net a 4.2% yield per year just by holding the instrument. They settle at $100 per bond. Now, what happens if the central bank raises the interest from 3% to 5%? Well, investors will demand a higher yield to buy this bond in secondary markets. So instead of paying the fair price of 96, given that that's 1 year until maturity, which would result in a 4.2% yield, those investors will bid lower at 94 for the bond, equivalent to a 6.4% yield to compensate the risk and pay a bit higher than a Fed funds 5% rate. Basically, raising interest rates is awful for bondholders. They lose money. JPMorgan's Bob bet was that inflation would eventually cede, even if it was due to a recession. So his timing was right. Sure, for a couple of months, inflation continued to soar. So his yield was probably lower than the inflation's 9% peak. But having 40 years of experience helped. So Bob continued to add positions instead of panic selling. Now, let's see what happens to the JPMorgan's investment if the inflation stays at 3% and the Federal Reserve decides to lower the interest rate to 2% to avoid a recession. Remember, in our theoretical exercise, JPMorgan paid $94 for a 6% yield when inflation was escalating. If the Fed funds are reduced to 3%, it doesn't matter for Bob, considering he paid $94. All that matters is the bond will be settled at $100 on the expiry date in 12 months. So the key to become profitable trading bonds is buying when investors believe that the interest rate will continue to increase when the inflation is on the rise. Okay, and what is the impact for cryptos? If the Federal Reserve lowers interest rates after 1 or 2 more rate hikes in 2023, well, if that happens, if they lower the interest rates, initially it's going to be negative, as it signals that the soft landing plan has worked. However, that might be a strategy to hide the economic weakness. So basically, kicking the can down the road. In either case, make sure to have a portfolio that can survive until 2024 and 2025, when the impacts of the recession are likely to hit markets. Well, that's it for today. I hope you guys enjoyed the show. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel.